for tonight. Joining next to me is Mr. Sherman, the Assistant Director for FSM1 Investment Counselor. Thank you for coming, Sherman. Mr. Sherman is an expert in global market research and analyzing investment products. Next to Mr. Sherman is Julian, one of our portfolio manager here at FSM1. He's also a CFA charter holder, and he has 9 years as an equity analyst covering US, Europe, and ASEAN markets. So for those who are joining us tonight, this session is broadcasted in Zoom, YouTube, and Facebook. So feel free to post up your questions in the Q&A session if you're watching from Zoom. And also, you may also post up your questions in the comment section if you're watching from YouTube and Facebook. As a disclaimer, any of the recommendations and products mentioned in this session should not be construed as a personalized investment or a buy-sell call. Please do your own due diligence and understand your own risk profile before investing into any products. So without further ado, I would like to start. Basically, the theme for the AMA tonight will basically how to navigate on the current market environment, and we hope by the end of this session, those who are joining us today will be much more informed on your portfolio and also how to navigate the market. Okay, I think as a start, I'll probably start off with the main topic, which is the one sector that is quite talked about, which is the semiconductor space. Now, in terms of backdrop, I think most of us will probably be aware that the semiconductor names have been rallying very dramatically for the past recent times, yes, because of like the AI development and so on, right? Mm-hmm. Maybe I'll start off asking the first question to Julian. Semiconductor names, like Nvidia, AMD, and all that, have been rallying strongly, right? Yeah. What is actually driving this rally? Maybe you can explain to our viewers here what's the driving force behind the rally recently.
Yeah, so I think the main driving force would be the ChatGPT moment. So This was when ChatGPT was released to the public, and it was quite revolutionary at that time. They thought it could disrupt multiple types of businesses, and all these cloud players saw a big opportunity there, and they decided to spend a lot on data centers because running these large language models that ChatGPT is a part of it requires a lot of computing power. And that is what drove the sharp rally that we saw back in 2023, where Nvidia became the stock darling of the global markets. And now coming into this year, we're starting to see memory becoming the main bottlenecks.
So that's also one of the sector that has been gaining quite attraction in the market as well, right? Memory.
Yeah, so memory, I mean, quite an amazing rally if you see this year. Micron, SK Hynix, Samsung going up by 3 times. SanDisk going up by 5 times. Yeah. Well, that's quite amazing. But I would just like to remind our viewers out there that this memory sector is still a very highly cyclical sector. Over the past 20 years, you've seen multiple boom and bust periods. So I will look back at history back in 2012. That was the start of the smartphone boom. So back then you see smartphones having 512 megabytes of memory, suddenly going up to 1 gig to 2 gigs. So people were thinking, oh, this is the new product trend that would be there for a long time. But then after a few years, the smartphone adoption pretty much hit a saturation point. And these memory players, they build up capacity to meet some of this future demand, not knowing that suddenly the adoption rate just plateaued. And that led to memory prices falling off the cliff because of this oversupply.
Understood.
Yeah, and then we also have 2016, there was the cloud computing boom. And this is when cloud adoption rates started to shoot up the roof. So again, memory guys built up capacity. And then after a while, the adoption rates again plateaued. And then they are stuck with this influx of new supply, which then caused your prices to drop again. And now moving to current markets, there's this new memory called HBM, high bandwidth memory, that all these AI chips are using. And now, given that the AI capex is so high now, again, memory players are also increasing their capacity. So the question is, will the same thing happen again? So right now, it's still too early to tell. But this is something that I think all investors have to be keeping a close eye out.
Okay.
I think if I may add, right, for BD for GPU, for CPU players, or even for the memory players, right, you need to take a look. Is in like it's not about whether AI is a bubble or a boom or a fake story or not. AI is real. I mean, for the past 2 to 3 years, you have seen big boys posted stellar earnings. I'm talking about trillions or billions of earnings growth. So if you look into that, right, that means basically AI is real because there is this AI race where everyone is spending capex to build AI infrastructure because they want to embrace the future of AI. So the demand is real. We have proven to that, and the market has already voted by ramping up the market price for the stocks. But for the next 6 to 12 months, you need to see how are the big boys doing. For example, if you were to see, you were to gauge is the memory stocks too expensive or not, right? Other than the usual PEs or PEG or the earnings, right? You should also take a look into the big boys' numbers. For example, Microsoft, their own growth in their Azure. Google's revenue when it comes to how much have they been monetizing the AI. Key numbers from OpenAI and also Anthropic. If these numbers continue to grow at a very exponential rate, that means this team, BD on GPU, BD on CPU, or BD on memory chips can still run pretty hot. It doesn't mean that whatever has done in the market, or like what Julian said, you've gone up 200%, 500%, 1,000%. You see Seagate, take a look on them. It doesn't mean that whatever comes out or goes out will definitely fall. If the story is still intact, when the sentiment is still there, then chances are these stock prices can still be pretty elevated for some time.
Okay.
Yeah.
So that being said, right, okay, let me get back to, we also collected some questions before this session on our Google Forms online. So I guess one thing I want to relate is that this is a question that asks that in terms of valuation, is semiconductor, I'm going back to the semiconductor space.
Yep.
Is semiconductor considered overpriced? Because we always think that, when you're investing looking at valuation for the long term. So is it too late to invest now? And do you see maybe perhaps, is there any pullback maybe in the short term, or maybe will the rally just continue from here?
Yeah, so I'll take this. So for memory, it's actually quite deceptive when you look at PEs. So if you look at it historically, the best times to invest is actually when the PEs are extremely high. So why is this? Because this industry, as I mentioned, is highly cyclical. So there are times when these memory players make supernormal profits, and there are times when they make very low margins, maybe almost break even. So in these times when they make supernormal profits, that is when their PEs actually shrink. You get single-digit PEs like what you see right now. And the times when memory prices are falling, that is when their margins are thin, and that is when their PEs actually look very expensive. Okay. So I know there are a lot of arguments that say right now PEs are very cheap, but you have to look at it with a different lens. This is a highly cyclical industry, and given that the share price has gone up exponentially, I think a 10 or 20% pullback is something that's healthy. I don't think you should look at that as the peak of the market.
Yeah.
Markets don't move up in a straight line. So a pullback is an opportunity for you to buy.
Okay, so to reiterate, basically, if let's say in the coming weeks or months, there is a pullback, let's say in the semiconductor space, it should be considered as a good opportunity to re-enter the market. Or even if, let's say, you are already invested into it, it's also a good opportunity to add into it as well. Would you say that?
Yeah, I think if the current trend still hold, like as what Sherman mentioned, the AI story is still there. OpenAI, Anthropic are growing their revenues at this kind of pace. I think the AI spending will continue. And this will translate into semiconductor and memory stocks moving higher from here.
Okay. All right. Thank you for answering, Julian. Going next to another question. So, for example, if I hold the SMH ETF, semiconductor ETF, and let's say I'm already having high double digits percentage return, from holding into this ETF. In terms of let's say portfolio management, right? Do you think it's good to actually lock in the profits, or is it just better to just hold on to it and just let it ride? Or if there's any pullback, you add into it as well.
Well, in investing, it's never wrong to take profits.
Okay.
Money in the hand is always better than the paper gains out there. But I think you got to ask yourself this question: can you take it if the share price falls 10 or 20% from here? At what level are you comfortable with holding these ETFs? If currently you're holding too much and you feel like 10 or 20% is you can't take it, then I think it's better to take some profits off the table.
Okay, understood. So if you are satisfied with the profits that you'll be getting, then it's a good opportunity for you to take the profits. And then maybe we can redirect that to another market. That's possible.
Yeah.
So if let's say I want to look for value in another market, for example, given the maybe volatility or any geopolitical developments or risk of geopolitical developments that could happen, is there any other sector or region that I could switch into or maybe diversify away from, if let's say I'm just holding into technology? Yeah. Any other region?
Asia. You cannot ignore Asia. I mean,
okay.
There are investors who love US stocks. They always love US stocks. There's nothing wrong with that. But if you're looking for value, where if you think that US is at all-time high, you want to look for valuation in terms of they are cheaper on a relative basis. Asia would be able to give you similar opportunities. So what I'm trying to say is that just now Julian mentioned SK Hynix, Samsung, and also names like TSMC. They are all in Asia. So in IFRS, within the house view, we have our theory whereby the US boys are focusing on designing the chips. But at the end of the day, who manufactures them? It has to be Asia, because these are the jobs that the Americans has been exporting to Asia for decades. So it actually enable the production capabilities in Asia that is now focusing into Taiwan and South Korea. They are the upstream industries whereby they will be benefiting from this. That's why you see memory players are focusing into not just into Asia. You have similar names in Taiwan and South Korea. So Asia will be able to give you this kind of opportunity, because if the demand is real, your manufacturing capabilities would not be neglected. That is why you see there is a headline from Bloomberg: investors are rotating, looking into Asia just because of the version. It's more reasonable, and they are telling the same stories. Their orders backlog are all the way into 2027 and even 2028. So that actually tells you value play. You cannot overlook Asia.
Okay.
But of course, within Asia, you can go into countries like Japan. Other than Taiwan and South Korea, you have Singapore. They are also equally important, but they are telling different stories. But no matter how, you can't get away from the AI trend. Yeah.
Okay. So with that being said, right, if let's say in terms of house view for FSM1, will there be any more upside coming for the Korean market for the rest of the year 2026, or even up to the middle of 2027? Do you reckon?
I think that is largely dependent on where the earnings growth are pointing. South Korean boys like SK Hynix, Samsung Electronics, TSMC from Taiwan, their earnings. Actually, there's nothing wrong with their earnings. Their quarterly earnings is beating over and over again. But what drives the market sentiment right now is that the guidance, the capex, because market already know that you will be beating the estimates for sure. If you look into how Nvidia behaves, or I take a closer look at home into Asia, TSMC, SK Hynix, Samsung, beating earnings estimates, it's not a problem. The problem is that the guidance. And so take an example. In mid-April, when TSMC announced their earnings, quarterly earnings, in fact, the earnings was tremendous.
Yeah.
Was booming. But in the same day, market penalized them just because they are not as ambitious as what market has been expecting. Because they refuse to give guidance that is too far ahead. I'm telling you that, you know what, the next quarter and the quarter later, I'll be spending this much. But market wants a full year forecast. To me, that is too early to tell, because even for companies like them, they need to do their own guidance. They need to fork out their own guidance to measure, because right now everyone there is a supply constraint here. So you see recently there is news whereby even the revival of Intel, amazing, right? I mean, short term they flipped. This is because the market is facing on this supply constraint. So when TSMC the capacity is fully utilized, the other market players is looking for alternatives of TSMC. So they turn into Intel's. Apple signed something with Intel, looking for can they produce chip for them for their own usage. So that is an indicator telling you whereby demand is real, and the Asia boys are even working very, very hard to meet the demand in the market. So can they go higher? I think the earnings is there for us to prove this theory. Market, I mean the outlook for South Korean market or Asia semicon as a whole is pretty bright. But the question you need to ask yourself is that how much has it been priced in? Are we been pricing in too much optimism into that to the extent that we have forgotten you still have geopolitical tensions, like be it in Middle East or be it in the upcoming presidency and Trump summit? You have a new Fed chair that is going to be in place by the end of May. All this will bring in volatilities.
Okay.
Yeah.
So bottom line is sentiment of the market is also quite important. So the expectation of the market and also how optimistic the market is also a huge factor in how well the market will, will behave.
Yeah, you see the entire month of March when we have a war between Iran and also Israel.
Yeah.
All these memory chips, memory stocks, GPU stocks, stocks, all been free falling for a few days. Does the market suddenly not believing in AI? So that is not the case. It's just that the market is rotating into different themes. And when sentiment is bad, right, no matter how good your story is, you will still be beaten up. So instead of asking, could it still go higher, is that everyone should think about, from this point of time, how much volatility am I able to stomach? Can I still hold the same theory, still hold the same conviction when, like what you asked, like when the stocks fall 15 to 20%? Can I still hold on to it? So I think that's the more important question to ask.
Understood. Okay, thank you for answering that, Sherman. Okay, moving on to, let's say, our next topic. I'd like to touch on US software. So I have a question here asking, what's your opinion on software and cybersecurity ETFs? Given with the rise of AI, many speculate that AI will replace software businesses. Yeah.
This is to me, right?
Yeah. I don't want. Yeah.
Well,
Okay.
You guys both can answer it.
Software, to me, one word. Two words. Oversold.
That's one
Oversold
word.
is one
That's
word.
one word.
Second word is it's selective.
Okay.
So the problem right now with software, with the market is that, towards software is that market participant thinks that AI will disrupt how software companies work. Or they are betting enterprises will see software companies differently because of AI. Because AI can do everything, and why do you still need software companies? So you can see, basically, the market story is like this. The market is rewarding different sectors. For example, infrastructure, okay, hardwares,
Okay.
hyperscalers like Microsoft, Google, all these big names, data platforms. Cybersecurity is important. We will go into that later, but and also AI compute, and also companies who are deeply embedded into enterprise ecosystem.
Okay.
That means they are deeply involved in companies' daily operations. You cannot replace them. That means that companies which have moats. But the market is also gaining more skeptical towards standalone workflow companies or software or apps, or companies who are more feature-based, and also companies with a weaker switching cost. For example, today, I asked you to, with AI, right? AI can help you to write articles or write-ups or emails. Would you stop using your Microsoft Word?
Not necessarily.
Because now the question is that if you don't want to use Microsoft Office, which software are you switching into? There is a cost, right? So if the cost to switch over is weak or is easy, AI is disrupted. Software is so-called disrupted. So the market is overselling this theory, and this theory has been amplified towards the end, whereby software companies are being oversold. So you need to see which companies are generally viewed as structurally stronger. In our view, we do think companies like Microsoft, ServiceNow, Salesforce, CloudStrike, they are the one who has their own moat because they are either they own those mission critical enterprise data. They are sitting at an infrastructure level, which is hard to replace. And these are the companies that will be benefiting directly from AI adoption. And also they have their own ecosystem that is hard to be replaced or to go obsolete. So that is the case because software companies are mainly, back then, they are very headcount based model. That means you pay by how many users. All right? That is how you charge your companies, your clients. So with AI, marketing said, back then, 10 people or 10 staffs need to subscribe this software. So I pay for 10 licenses, right? But with AI, maybe I don't even need 10 staff. I only need 2 staffs. Then that means subscription towards the software will go down, right? That is what market thinks. But what if I tell you these software companies are slowly transitioning into a consumption-based model? That means you pay as you use. You pay by what is the token that you have used. So that translates into a very sustainable so-called business model for the software companies. Because you can't replace them and they are charging you based on your consumption. So with this theory, whereby as the AI cost goes cheaper, would you use it more or would you use it lesser? You definitely use it more. Everyone uses AI right now.
Yep.
So when it gets cheaper, you have more usage. So ultimately, you are looking at these companies who are their EPS is growing about 33%. That is much higher than what you are seeing compared to S&P 500, who is only at 25% EPS growth. So when the EPS is growing, are we telling the market that software companies is doomed? I don't think so. So that is the house view towards the software companies.
Okay, that's quite a lot for me to digest, but I can I can basically understand it in a way that the business model from AI companies are quite revolutionary in a way that instead of having multiple subscription or licenses for a software, you use a single AI system based on consumption, which is dependent on the token that you are being used.
Yep.
Right?
Yeah.
Okay.
Maybe I'll add a bit on the cybersecurity side because the question asked. I think we all know that AI tends to hallucinate.
Yep.
So if you're using AI to write code for cybersecurity to protect your systems, what if it hallucinates? For cybersecurity, being 99% right is probably not good enough. You have any hack, even from this 1%, it will cost you millions. Do you want to save money on these cybersecurity tools just to save that kind of money and risk your company data being hacked? Yeah, so I don't think AI at this current stage is ready to replace cybersecurity just yet. So I think that is an area that I am quite positive on.
It's totally the opposite when you have AI. You need a stronger cybersecurity model that is enhanced by AI.
Like a supplementary to support the current AI.
I just want to give a very simple layman example. You have Department of Defense, or you call it Department of War in US right now.
Yeah.
They are signing contracts, agreements with AI companies like Anthropic. Are they replacing the soldiers? They are not. They are helping the soldiers to fight a battle. So ultimately, same theory applies to the companies when you've got AI threats where your AI tracks all the so-called hackers threats are evolving at a very exponential way because of AI, thanks to AI. On a defensive side, the companies also need needs AI help. So if you refer to the Anthropic CEO's interview recently, he's saying that we are not here to replace you guys. We are here to help. We are telling you you can use AI to train your models so that you can defend better. Because it's a matter of time whereby the companies realize, I actually need a much stronger cybersecurity system because I cannot afford to be hacked. Because AI is so smart. My defensive model also needs to be smarter.
Okay. So then now, I guess since we've been talking about software in the US, I would like to also touch on the US political scene as a whole. There's a midterm election coming up, right? So there's a question that is that I collected is that it says historically a few months leading towards US midterm elections, US markets were correct. Based on historical data, on the average, what is the magnitude of the correction? Is this something that is something to be concerned about with midterm elections coming up?
I think on the midterm elections, so you see a trend whereby during midterm election years, from May to about November, that's when the market tends to be at its weakest. But then bear in mind, during the third year of the presidential term, which will be next year, historically, that is the best year out of the 4 years of every presidential term. And heading into these midterm elections, what we expect to see is a divided Congress. So that usually means that policies won't be passed. Any new laws or rules that they want to pass will not happen. So that means there is stability in the markets. And with stability, there is predictability, and that is what the market likes. So that if that were to happen in the US, actually that is a pretty good sign for the stock markets as a whole.
I think you're referring to the market performance after the election, right?
Yeah, so it's on the third year. So now we're in the second year of the presidential term, which is the midterm elections. So historically, third year tends to be the best out of the 4 years of every presidential term.
So are you indicating you're indicating that this is a good year to accumulate, right? You can tell from the current approval ratings for Trump right now. In US, it's like what Julian said. the Conservative Party, which is the current governing parties right now in White House, which is Trump. Approval ratings is going all the way down because of higher oil prices in US. Consumers are getting a hit. They are paying the bill for the war, which at this backdrop, your approval rating will not be pretty, for sure. So, which links to the theory why we think that the war will not be prolonged, because you have this pressure from US, from your midterm elections. You got to fix that living cost matter, this issue, before you go into an election. So coming into that, we expect when you have election ahead, you will tend to be issuing more aggressive statements because you want to show to your voters you are a president. In US context, you are working very hard for US citizens, US voters. In that sense, based on what we have seen from Trump for the past 2 to 3 years, these comments can sometimes be aggressive towards their own allies or to countries like China. And markets are not going to like that. So the comments or feedbacks tend to be a bit more hawkish. When that happens, the market would tend to shy away from the market temporarily. Like, I will just sell first and think later. So that's where the volatility comes in. And when you are campaigning, you will try to introduce new policies, right?
Yeah.
Market will wonder, what if you really win? And after you really execute this, right, what will be the impact? And that is when market reshuffle. So this volatility will kick in as your election campaign intensifies. But like what Julian said, if historically speaking or statistically speaking, if the third year is the best year, statistically, then this year is definitely got to be, the volatility will give you opportunities to accumulate companies that you think will be able to fare better.
Okay.
Not like sweet buying. We're not talking about you in a more layman term, you sapu. No.
Okay.
So, but you need to be selective. Yeah.
All right. Julian, want to add anything?
No,
Okay.
Yep.
All right. With that being said, if let's say the outlook for the US market after the midterm election will be just as how you see it, maybe it's a good time for us to accumulate during this year. How would that affect any other markets, maybe in Asia as well? Because usually from any developments that happens in US, it tends to have repercussions in other markets as well.
Yeah, I think with if we are expecting the third year of this presidential term to be the best performing out of that, the funds got to flow from somewhere. And given that we've seen such a strong outperformance from like Korea, Japan, even Singapore, I'm not surprised if there are some funds that will look to rotate away from this region and back into the US. Like I mentioned, if the US has a split divided Congress, things will not change. No new policies will be passed. That is something that the market likes because I know what to predict, and that makes it more investable.
I think also to add, if you are thinking about, I think the repercussion is real. When so there's a saying in US when the US sneeze, the world gets sick.
Yeah.
The world gets a cold. Yep.
All right.
The US sneeze,
When the
the world
US
gets sick.
sneezes, the world catches a cold.
Yeah.
Okay.
Yeah.
So similarly. So, but looking for markets that is more resilient, I think that might be the question you want to ask. Which market will be more spared or more resilient? In our view, just now we mentioned Asia, right?
Yeah.
Actually, referring to single country, we think Singapore will be able to give you this kind of resiliency.
Okay.
Yeah. Okay.
You bringing up Singapore.
Yes. Singapore is resilient. We love Singapore.
Elaborate.
I mean, wow. Okay. Singapore as a country, Well, I think since the beginning of the war between Iran and Israel, market suddenly realized this thing as in like, wow, Singapore is so resilient, because back then people see Dubai, people see Abu Dhabi as another global financial hub that is viewed as safe and stable, because they can be as safe as Switzerland. But when the war breaks out in Middle East, market suddenly rethink, maybe I should just park everything in the Singapore. So you have capital flows into Singapore because they are deeming Singapore as a safe haven. You're not gonna see the Middle East as the best location right now, because anything can happen, and you might get stuck. But Singapore as the one of the most important port or even financial hub in the world or even in Asia, Singapore gives you that kind of stability in terms of economy resiliency and also political stable. When you buy into Singapore equities, if you just buy the index alone, 60% of the economy is made up by banks and financial names like banks and also REITs. And they are strong dividend payers. I'm talking about big banks with super solid balance sheet, and they are giving you, and that their dividend yield is about high 4 to 5-ish.
Yeah, 4 to 5.
4 to 5%. REITs are paying you 5 to 6%. So to me, when instead of we say Asia, we focus on Singapore. Singapore is a place that is you are paid to wait. So that means when even if you're parking your funds in Singapore equities, not only you enjoy the capital growth, if you notice how Singapore equities has been doing so over the past 3 years, you also be paid for good dividends. And these dividends are stable and it's consistent and it's pretty decent, to put it this way. I always ask people this question as like, if I give you multiple currency, just pick one currency. I think a lot of the votes will always go to Singapore dollar, because the market is right now is in a doubtful mood towards US dollar, because your foreign policies is so volatile. The way you treat your trading partners is such aggressive way, as the market might want to has lost confidence towards the US dollar on a relative basis. So which currency would you be favoring? I think Singapore dollar would be a very, very easy destination to receive all these fund flows.
So basically, bottom line from what you're saying is that because Singapore can be considered as a safe haven away from, let's say, if there's a lot more volatility in the US.
Yes.
So in terms of, let's say, if I'm heavy into the US or heavy into tech, and I want to diversify somewhere into a more stable and resilient market, then Singapore is probably a good option for it.
Yep.
Okay,
You're right.
understood. Okay, if there's moving on to that, is that I would like also to ask a similar theme to Singapore, which is a single country Asia, which is Japan. Yep. So both of these, I think, we also have a question asking about Aham World Series Japan Growth Fund. I think one of the questions,
That's one.
what's the prospect for Japan? Aham World Series Japan Growth Fund, hedge growth for this year seems slowed down. Yeah. What's the prospect for Japan, you would say?
The prospect to Japan, it's still very similar. Back then, people think that Japan is a boring economy because the country we're talking about a country that has not seen real inflation for the past 35 years.
Yeah.
But since 2022-2023, everything got reversed because the story is more towards structural growth, structural reforms. Your corporate earnings are picking up. You have domestic reflation. That means domestically, people are spending more. When it comes to inflation, there are two types. One is demand-driven, one is supply-driven. What we have witnessed in 2022, that was supply-side driven. That means you have a supply constraint, then it costs everything to get more expensive. That is bad inflation. But when you have a demand-pushed inflation, which is good for the economy, because as the companies are earning more, the companies in Japan are improving shareholder returns. That means more share buybacks, more dividend payouts. So investors suddenly receive more and more payouts, then that is good for good on the income side. You are improving the consumption power in Japan, be it from the foreign tourists or be it from domestic spenders. So ultimately, you are actually seeing the Japan story is totally different right now. They are not just doing exports, but the domestic story is very, very intriguing. So we still hold a very positive views towards Japan. Even though recently you have noticed Japan might be slower, but that is on a relative basis compared to other Asian nations with more focusing into Taiwan and South Korea. But if you, I can see you're showing the funds chart. If you look into year-to-date basis or 3-month basis, I think it is quite a good number.
Yep.
Because we are talking about a backdrop of a war right now. Japan is not just domestic story. They are also benefiting from their names, from some names that is controlling on semiconductor manufacturing and also materials. So Japan has few stories going on. One is structural growth, and also on the other hand would be the semiconductor story together. Yeah. So I don't think Japan's outlook has dimmed. In fact, Japan's story has proven itself to be a more structural. People used to see it as a tactical portion, but in fact, we should treat Japan as a core portion.
Ooh.
Yes.
Okay. Even if it's a single country?
Yes, correct.
Okay. All right. Okay. Anything to add, Julian, for Japan? No?
Yeah, I think with what he mentioned, inflation coming back to Japan, you have to understand that you need inflation for the economy to function well. And given that he has historically been deflationary, you have to think about how are these companies going to pass on price increases to the consumers. If it's always deflationary, there's no way for them to pass on price, and there's no way for them to grow earnings. It's very difficult. They have to rely on exporting. And now with inflation coming back into the market, that is actually a very healthy sign for the Japanese economy, because good inflation is around maybe 2%, and that's what they are currently having now. It's not overly expensive, overly high like what you see in 2022, countries having 7%, 12%. Now it's actually quite manageable. Obviously, the oil prices are inflating it quite a bit, but when it normalizes, I think a healthy inflation is a good structural driver for the Japanese economy.
The inflation from Japan, right, is also coming from the wage growth. That means Japanese consumers have received good increments. And the increment rate is something that the market has not seen for the past 30 years. So you can look into their workers' increment, which is their wage growth. It's 5%. Now, even though I know the number might look a bit small, but what if I tell you for the past 30 years, there has been zero growth in wages? So it's from 0 to 5%. And this is a broad-based recovery. So the consumption power is coming back. So that explains the inflation. Yeah.
And that's, I guess, from what you guys are discussing here, is that there's the fundamentals of Japan is, in terms of structurally, is quite resilient, right? And it's sound, and also it can be considered as a value growth strategy. Right?
You are actually seeing a very disciplined Bank of Japan. If Bank of Japan wants to raise rates, they want to raise rates for sure. That is in their plan. But if they want to raise it aggressively, that's not so good. But what have we seen? For the past 2 years, the BOJ, Bank of Japan, has been pretty disciplined in hiking rates. They are telling you, we are monitoring inflation. We know inflation has come back. But so long it is a demand-driven inflation, we are fine with that. And we have a plan to increase the rates step by step.
Okay.
So that gives plenty of confidence towards the policy certainties for Japan.
Okay. Thank you for that. Okay, so also I would like to add is that for this month, May 2026, the fund choice for FSM1 is also the AHAM World Series Japan Growth Fund. So until 15th of May, FSM1 users, you can enjoy a 0.8% sales charge and also 1% bonus units until 15 May. So terms and conditions apply for this as well. Moving on to, we say we have any questions, other questions that we have on Zoom. Let's see. Those enterprise. Maybe we have a segue.
I saw a question with regards to Warren Buffett sitting on the cash.
So the question here is, legendary investor Warren Buffett is sitting on a cash war shares of $350 billion. He's expecting a big market correction, aka crash. How do we hedge against high valuations in the market now?
Julian, you want to go?
Yeah, so I know a lot of people follow Warren Buffett's cash holdings very closely. Every quarter it reports, and the number seems to be getting bigger and bigger. Until now, it's ballooned to about 300 over billion. But you have to remember how Warren Buffett invests. He only invests within his circle of competence. So if you look at his holdings, there are no AI companies to be found. And if you look at it, do you think that he doesn't know that this sector is booming? Of course he does. It's just that he doesn't understand this area well enough to confidently put his money in. Even if you look at his top holdings, Apple, he bought it back in 2016. That's a long time before he missed out a lot of returns. So that shows that he's actually someone that is very, very patient. And at the moment, given that his size, you have to take into account that his fund size is 300 over billion. There are not that many companies out there that he can actually buy with this sort of war chest. So he's waiting for at least a stronger pullback before he will look to add into any stocks that he may find interesting.
I think for Warren Buffett, he has been constantly saying to the markets as like, I mean, if you look into his interviews, he's been saying things like, I don't think there's anything for me to buy right now.
Yeah.
But he has been saying this repeatedly over the past few years. If we were to take his stance and apply it to the past recent years' market performance, you will have missed out.
Yeah.
So what I'm trying to say, I'm not trying to say Warren Buffett is wrong. I mean, Warren Buffett is sitting on the cash level where he thinks that it's comfortable for him to shop when things happen. But again, he is not predicting there will be a crash. It's just that if you look into the entire Berkshire Hathaway's holdings, Berkshire Hathaway is still investing into the markets. He is not telling you that I have already sold everything that I have and I sit on cash. In fact, given with his fund size, you need to see what is his portion of cash versus his total current active holdings. So the market always says, oh, Warren Buffett is raising cash. That means the market is going to crash? No, it doesn't. So at a different part of time when you look into things, right, it might give you different perspectives. But of course, right now, today, when market go all the way down 50%, then people will say, oh, Warren Buffett, you know what? He's right. He's really, really smart. But has he predicted it? No. He is just preparing himself with a healthy cash levels. So if we are able to learn one thing from Warren Buffett is that he never go fully invested. He always has cash on hand because he doesn't want to come to a point whereby the market is attractive and I don't have cash to deploy. So if I apply it to all the investors that invest with us in FSM1, maybe discipline is the keyword here. No matter how good the market is, you also want to have some cash on hand because sometimes the market would Trump wants to reward you with some market opportunities by saying some bizarre comments. That is when you can scoop the markets. Yeah,
as the saying goes, time in the markets beats timing the markets.
Time in the markets beats timing the market. So meaning it's better for you to just hold and then accumulate, investing into the high conviction market instead of trying to time the market up and down.
Yep.
Okay. Then if that's the case, and thank you for sharing on that. I think in FSM1 also we also have a tool in order for us to help, for our investors to leverage on this strategy.
Regular saving, you mean?
Correct.
Yeah.
So we have a regular savings plan tool on our platform where you can automatically set an instruction to automatically invest into a broad-based index ETF in US, Hong Kong, and also into US and Hong Kong. So the ETF RSP processing fee right now is at 0. So you are basically optimizing your capital to the max. Yeah. So for those who are interested, you can have a look at our ETF RSP tool in FSM1. Also, I think there's also some questions I would like to transfer you guys here is that talking about China, what's the outlook on China and why is the China market so sluggish recently? For example, the iShares Core MSCI China ETF is not rising like the rest of Asia. And also, you can also talk maybe about Hang Seng Tech. It's been remaining weak. Is this considered still an opportunity? Or are there still risks for Hang Seng Tech? You think?
So I think for Hang Seng Tech, right? I think the main thing that's missing there is there's no AI play inside. If you look at the top holdings, you got your, I want to call it old tech, your Alibabas, your Tencents, your Baidu, Meituan, Xiaomi. So these are the ones that are the heavyweights. Whereas the ones that are rallying, if you're comparing to Asia, those are all AI related. In Japan, Korea, Taiwan, the top market weights there are all AI related. So I think that is one of the main reasons why market is pretty sluggish. Funds will likely rotate away from Hong Kong towards these other regions within Asia. But I think to note whether there's an upcoming catalyst, I think what investors are probably looking for would be how some of these big cloud players in China, your Alibaba, Tencent, how are they able to monetize the AI models? Because I think they take a look at the big US hyperscalers, your Microsoft, Amazon, Google. They've all reported very strong growth in terms of AI. But you don't see that. You don't see that in Alibaba and Tencent. So I think that is what investors are really hoping to see maybe in the upcoming results. And secondly, also maybe something that can potentially catalyze the markets. The AI names in China mainland, which is your Knowledge Atlas and Minimax, they are also listed in Hong Kong. So they are actually being added into the Hang Seng Tech Index next month. So that could be a potential catalyst for investors back into the Hang Seng Tech Index.
The issue with China is about confidence. The market, everyone is aware whereby China's AI development actually is very bipolar. There are people who think that when US ban high-end chips exports to China, China will suffer. Which is true because you see the AI models in China has developed on a relative basis. While we talk about Anthropic, or which is your Claude, or even your ChatGPT AI, your AI from OpenAI, or even Google Gemini, comparing with China models like DeepSeek, how many versions you have seen from US AI models comparing to China AI models? So the impact towards China is real. The market wants to see more evidence from Chinese players, as in like, how can you continue to develop your AI capabilities when your chips supply is limited? So that's one thing. So that is about confidence. Second is like what Julian said. Your fund flows is like, I don't need to stay in Hong Kong or China right now. I can just rotate out to South Korea or Taiwan or Japan. If I want safety, I go to Singapore. Market is waiting for clarity from policies. You know, China as a very different kind of economy models. All this sentiment would be attracted when the policies is giving a clear direction, as in like, you know what, no matter how, I want you to push on full throttle on AI. It's not that names like Tencent, Alibaba, Baidu, they are not making money. They are making good money as well. and their consumer base remains very, very huge because China alone is already a very big market. But when you compare to AI development, there are tons of data where it comes to AI usage on tokens across the world. China models are not lagging behind. But market has not seen any clear indications and how much are you in monetizing your own AI capabilities. That's what the market is trying to see.
Okay.
Yeah.
So keyword here is confidence and sentiment.
Correct.
I would say, because the market is not actually seeing a lot of AI developments in China.
But just now you want something cheap, right?
Yeah.
So valuation play on a relative basis, China is giving you a very valuation catch up.
Yep.
You can, if investors are looking for, I want something that has AI capabilities, but they're still cheap. There's no harm to position into Asia. I mean, into China or Hang Seng Tech in particular. But what just now for the past 2 to 3 minutes, what we have been explaining is that why year-to-date basis, Hang Seng Tech has been sluggish. But imagine if things rotate, if policy gives more clarity, confidence come back to China-related AI tech stocks, that marks a pivotal point for names in China or even Hang Seng Tech.
Okay, so from what you want to add anything?
Yeah, I mean, just now when we talk about fund flows as well, I think if you read the news about last month, there was a news that the China national team, Central Huijin, they actually sold off a huge stake in their China ETFs to a point where they now don't have to disclose how much they're holding, which is below the 20% shareholder ownership rate. So that is also a potential catalyst because these funds will eventually return. Just a matter of when. And you want to position yourself before the funds come back into the markets.
Okay, understood. So if let's say if I were to summarize Asia as a whole, right? From what I can see right now, you're saying that Singapore is more, if you want, stability and more predictable
A safe
performance, a safe haven, a safe place of Asia. Korea and Taiwan is more for growth.
Correct.
Because of the memory names and also the semiconductor, right? TSMC. Japan is more for value and also structurally it behaves the same. I would say it's the same perspective, same prospect to Singapore. It's just that maybe different names.
It's a re-rating. Re-rating story.
Okay, so there's developments for structurally in Japan to make it more of a fundamental play and also a core position for your portfolio. Whereas for China, there's potential for it to become a value play. You see?
Yeah.
Yeah. Okay. All right. I guess I hope that answers some of the questions that's already put it up in the Q&A section. And then I think we can like go through some of the questions rather quickly. Is that Korean stock?
I think that one we answered already.
Yeah, so Korean stock, whether it's cheap, maybe there's
cheap.
a replay. You can I addressed this
Earlier on.
Yeah, you can watch that.
Yeah.
I saw questions towards SpaceX related stocks.
How about SpaceX related stocks?
Okay, so when we talk about these companies that is going to be publicly listed, you know, SpaceX or even Anthropic or even OpenAI is planning for a listing in US.
Oh yeah.
Later into this year. Though they are private equities, but that does not mean that you don't have opportunities to capitalize on this. For example, there is an ETF in US is called DXYZ. DXYZ.
Okay.
This is not a investment advisor. I'm just telling you there is such an ETF.
Okay.
The name is called DXYZ, where the top holdings are all private equities like this, Anthropic, OpenAI, or SpaceX. So if you were to capitalize on these few names, you can think about it. But disclaimer is that these stocks are non-public listed yet.
Okay.
The market always apply a premium towards all these names. That means you might be paying expensive price for something that is probably worth lesser.
Okay.
When the market sentiment is good, right, optimism will push up all these prices. So if you take a look into recently onto space exploration stocks, plenty of the company, like out of 100 companies, only 2 to 3 are really making profits because they are largely of their earnings power is looking on how successful they will be able to launch missiles or satellites into the space or data centers. But you need to know all these are still on experimental phases.
Yeah.
Some of them are still loss making. When the tide turns, when volatility comes back, when market values stability again, all these high PE stocks will be penalized. I'm not saying that they don't have any future. You see how SpaceX, their progress is amazing. But does it apply to the rest of the similar stocks? I think the risk is higher on its nature. Yeah.
Okay, so if you're talking about this pre-IPO private equity stocks, such as SpaceX is rather volatile considering its private nature, right? So be that as it may, have to take that with quite cautious.
Definitely. It's a super tactical name.
Okay, sure. All right, maybe we go for any other questions that we have on here. Can we scroll down a bit more?
This is
Okay. Yes.
Gold.
So one question here is one asset class that we haven't touched on. What's your view on gold movement moving forward? This is quite
So I think to start it off, let's look back at why gold has gone up so much anyway. If you look at the US treasuries, the holdings by foreign countries, that has been falling tremendously over the past few years. And the biggest seller here is China. And where are these funds going to? If you look at China's holdings of US treasuries going down, but if you plot it against the holdings of gold, they are actually the biggest buyer of gold. So they are transferring the US dollars into a different asset class because they have, in a way, lost confidence in US dollars. And similarly, you see across the world, many countries have also started to move their foreign reserves away from the US dollar and into gold. And that is what is driving gold prices up. Central banks are also buying gold. But how is it going to look like moving forward? Personally, I don't see gold as a core part of your investment. To me, it's something that is supplementary as a store of value, as a hedge. At most, about 5-10% of your portfolio should only be in gold.
Yeah, you should use gold as a portfolio diversifier. But if it's becoming your core allocation, that will have a problem. Because if everyone loves Warren Buffett, do you know Warren Buffett actually do not like gold?
Oh.
Because he is saying that gold is non-productive. He will be rather to hold companies that pays him dividend. I mean, coming back to here, it is that the recent years when gold has done tremendously well is like what Julian has mentioned. People is trying to increase the holdings of gold. I'll use the word increasing. It's not because of replacing. To me, people constantly ask like, would US dollar be replaced or will US dollar crash? This topic has been there since 1970s. When you have first your first oil crisis in 1970s, people want to like de-dollarization. Is it real? Now, de-dollarization is real, but it takes decades to happen. It takes decades to complete. Because you take a look into dollar, it is still the most important currencies in the world. Your trade, everything, you can't get away from dollar. You actually can increase other currency holdings, but you won't kick the US dollar out from your basket. I think that applies to all the countries. But last year when Trump comes in with his Liberation Day, basically gold has become another alternative because US dollar value might not be the best store of value anymore. you want to take some gold position because it gives you better certainty at that point of time. So so it couples with the buying forces that Julian has mentioned. That's why you see, you think gold is a good hedge. You take a look on how gold prices behave when the war happened. Yep. If you remember, gold was dropping double digit in one night when the war has break out. So it's such a very, very timely reminder to tell you whereby gold is not always the perfect hedge for market volatility. And in fact, take gold as a portfolio diversifier, not just a perfect hedge towards market volatility. Yeah.
In fact, if you want to look at gold returns, if you just exclude the past 2 years, actually the S&P 500 outperforms it by a mile. It's only within the past 2 years that it has outperformed the S&P 500. So take it as a hedge, like what we have mentioned, and don't make it part of your core portfolio because you will be losing out on the gains from other asset classes.
So Julian, if that's the case, then better for me to just put, if let's say I want to invest personally, put more into S&P 500 and then just regularly invest into it. And then I see gold as a diversifier lah.
Yes. Yeah.
Pretty much. Okay.
Don't forget Singapore.
Yeah.
And Singapore. Okay. That was Singapore stand here. Let's see another
there's one question on long-term view
long-term
on AI,
view. Yeah, we had long-term view on
right.
AI and semiconductor UT, whether there is a buy or hold call now.
I mean, it goes back to your own risk profile right now, because let me put it this way. If you had invested in the semicon stocks or any funds, right, you, let's say 1 year ago or 2 years ago, you are looking at super normal profit. Super profit right now. I mean, I'm talking about 100 or 200%. If you already see you are comfortable with the profits, there's no harm to take some profits out. But is it a long-term hold right now? Is it a long-term hold for me to hold all these semiconductor stocks? If you believe in AI and you know AI is a structural trend that is going to be sustained and all the way until at least towards 2027 or 2028, I mean, to me, that is a long-term hold. But near-term pricing has gone up tremendously. You look into the Philadelphia Semicon Index, like consecutive 18 days of gains. The last time we see this kind of trend, that was the com bubble. Now, don't get me wrong. I'm not trying to say that we are going to see a repeat of the com bubble right now. But that also tells you something whereby the market is somehow nearing to euphoric the euphoric mood right now. There is an increasing number of investors making good profits from semiconductor stocks or memory stocks recently. This confidence may be misunderstood as ability to make money from the market, which is very dangerous.
Okay.
Because when you invest into something, you make good profits, you will have full of confidence, like, I'm able to make money from the market. But when short-term volatility hits you, if that is going to be the reason to sell away, this mindset tells you whereby you need to take some profit from the semiconductor stock right now. That means, so you are distinguishing clients into short-term player or long-term player. For short-term player, good profits. But why not? You can take some profits out. But for long-term players, I think you believe in AI, you hold on to it. But don't always wait for the perfect crash, because perfect crash might not even happen. But market opportunities comes from all these comments from your politicians or market events that will give you the good entry opportunities to accumulate more.
Understood.
Yeah.
Okay, so bottom line here is that what you're saying is that if you're willing to stomach the volatility and then holding for long term, let's say 3 years and above, then more power for you. There's more potential in terms of returns and also for you to ride the AI boom and ride the AI wave. And one of it could be going through a semiconductor unit trust, such as the Nomura Global Shares Semiconductor Equity Fund. one of it could be, this is one of the funds that's also available on FSM1. Okay, I guess let's say we go for a last final question. Do you see any trade potential? That one we've already answered. Perhaps we can touch last on any potential geopolitics development coming out of Iran or US, considering that the peace treaty, the ceasefire, maybe coming to an end soon. Maybe it's going to be shaky. Then could it be also affect the market?
Only Trump can tell you the answer.
Yeah, this ceasefire is quite interesting. Like they are, I think it was 2 weeks ago or last week that they were firing missiles and kind of testing the limits of how far they can go. They fired a missile and then they were saying, that's not enough to breach the ceasefire agreement. And then the US fired back, and it's like, who knows what will happen. But I think something to watch out for is when Trump flies to China to meet with Xi Jinping. I think it's on May 14th and the 15th. I'm pretty sure it's in both of their best interests to do something about the war in Iran. I think they have very strong ties there, economically or even politically. And I think these two superpowers, if anyone can do it, it will be the both of them. If they actually do try to work together to come up with something, a better solution that would actually be beneficial to both China and the US.
I think we need to look past on this. Like let me ask you one question instead.
Okay.
Russia and Ukraine war, has it ended?
Not entirely.
Not entirely. Means
there's still skirmishes around.
Has the market recovered from it? That means the market already moved past of the conflict and also the consequences, the ripple effect from the war. I mean, 2022 we suffered quite a fair bit.
Yep.
But 23, 24, 25, because of ChatGPT moment, that's where the market starts to recover. Similarly, I'm trying to apply these thoughts in this Iran and Israel or US war. Has the war stopped? They're still firing missiles.
Yep, still firing.
US is still blocking the whole stretch of Hormuz. Iran is still firing missiles sporadically into the boats or the vessels. But the market has already looked past it and move on to memory chips, memory players, semiconductor players. Market is still going well because the market already moved forward. So it's all about forward expectation to the markets. But I'm not trying to downplay the impact because the disruption towards energy prices is real.
Yes.
It's real. And it takes time to restore all this supply chain. We expect capex will be spent. You see, UAE, Qatar has left the OPEC alliance. More and more Middle East country is trying to find alternatives for Hormuz. That means the supply will restore, but it takes time. So I'm trying to set a floor to energy prices. Now, we cannot expect energy prices to go back before to pre-war levels. That means that it's going to be a floor towards energy prices right now from now on until the war settles. Because if you look into the US terms and also the Iran terms, the terms are very, very divided. Still very, very far from reaching mutual consensus. So don't forget that while the optimism in technology space is tremendous, is encouraging right now, but we are not trying to tell you the market is going to move out in a one straight line all the way out. There's gonna be volatility coming in. So the advice towards the clients or who have dialed into tonight is that there are plenty of reasons to be positive to the market, but we're not telling you that to ignore your back mirror because there are still some risks in the market. So the best way is to be staying diversified, have some cash because market will always gives you opportunity to pour into markets. But of course, if you want to take a safer bet, just like we mentioned, Singapore or Asia offers you a better catch up in terms of valuation, or you want to be more stable. That can be the way.
Okay. All right. I guess with that being said, that would conclude our AMA session for tonight. Thank you so much,
Thank you.
Sherman. Thank you, Julian.
All right, thank you.
Thank you for joining us and sharing your very valuable insights. Okay, so for those who watched us tonight, we hope that you benefited greatly from our speakers sharing the insights that they had about the market and other regions and other asset classes as well. So I would also like to add is that currently FSM1 is just upgraded their fee structure for ETFs for US and Hong Kong. So right now we have a flat fee for buying into US and Hong Kong listed ETFs. For US, the flat fee will be $3.8 US. For Hong Kong ETF, will be 38 Hong Kong dollar. So regardless of how much money that you're investing into the ETFs, the flat fee applies, regardless if it's 1,000 or 100,000. If you are looking for smaller size, you can go through the regular savings plan route, minimum with 100 ringgit, and also at zero processing fee. Besides that, we also are running a bonus units campaign for Asia Fund. So just like Sherman and Julian have shared today, Singapore, Japan, Greater China, like Taiwan, Hong Kong, and China, these funds are offering bonus units, which is 1% bonus units. So if let's say you invest 10,000, then you get 10 ringgit bonus units. 1,000, and then you get 10 ringgit worth of bonus units. Besides that, we are also running a new user rewards and also refer rewards. So if you are refer your friends or your families using your referral link, and then they open an account, activated the account, and topped up at least 100 ringgit or any form of investment, you and your friends or your family will get 25 ringgit credit into your cash account. And also for new user, you will also enjoy 25 ringgit and also new user benefits where you can enjoy lower fees for products on FSM1. This promotion is extended until 29th May 2026. Okay. All right. I guess that concludes our AMA session for tonight. Again, thank you so much, Sherman. Thank you so much, Julian, for your very insightful sharing session.
Thank you.
And for those who are joined, I hope we will see you again next time, and have a good night.
See you very soon.
All right.
Bye-bye.
Good night.
Bye, everyone.
Bye.